the plan to call, I mean, this should only take about 20, 30 minutes, but I want to test drive this new breakouts feature on the Zoom. So it'll give you guys a chance to connect with each other. I always think it's kind of neat to meet someone halfway across the country, and it's not very conducive to do it when there's like more than 3 people. I hate meetings when there's more than 3 people because you don't get anything done. So what I'm able to do with this thing is I'm able to split you guys up, groups of 2s and 3s, and you guys can kind of meet people one-on-one. But so the topic of today is, how do we invest in this seller's market? Last time I checked, the recession was in 2008, and it's been almost over 10 years since the last crash, and we're kind of due for one. But kind of starting out, this is going to be kind of a doom and gloom, the world is ending type of segment here. But just starting out, the population is still going up here, guys. Got the population charts. I just pulled that today from a recent report. Yeah, across the country, I mean, you're going up 2, 3, 5% all over the place. And then, there's a little bit of net migration, people moving out of Hawaii, California, going to those more pro-business states there in the South and Southeast. I'm just going to kind of hit over the highlights here. This is kind of what I tell a lot of people, should I invest or should I not invest? Robert Kiyosaki says he has 3 sides of a coin. There's heads, there's tails, and then there's the edge of the coin where the smart, sophisticated investors are, and they're able to pick out the good deals and invest, whether it's a hot market or a cold market. I think if you're unsophisticated and you don't know what the heck you should do, maybe you should sit out or at least learn, right? And I see this all the time with newbie investors. They self-sabotage themselves and they don't do anything because they hear it's a hot market, it's a hot market. You give yourself an out 99 times out of 100, you won't do anything and you'll take that out. So my suggestion is to learn how to do the numbers yourself. There's my analyzer online. I think it's simplepassivecashflow.com/analyzer. I don't know if it's spelled with an S or a Z. I think it's I don't know what's really spelled, how it spells in real life, but I know I spelled it with an S. What that is, you just analyze the deals yourself and you see what comes up, and you're trying to buy the best ones that you've been seeing. So you're just trying to find some data points. So that's a little screenshot of it right there. I guess as an investor, what you're trying to do is you're trying to, how they call it, dollar cost averaging in the stock market, but you're sort of trying to do that here with real estate. You're trying to find better than average deals and just constantly be investing, because one of the cool things is as you start investing, you start growing your network, and that gets you better and better deals. And that none of that happens unless you put in the effort, do the work yourself, and kind of level up your game. So I think I've showed you guys this about 1 million times, this chart. Is there anybody that doesn't understand what's going on here with this little stacking your portfolio together? So the gist of it is like, some guys will call me and their net worth is only like 200 grand. And I'm like, you shouldn't invest in a syndication or a private placement, because a lot of these minimums are $25,000 to $50,000. And you're going to be going in with a big portion of your net worth. And no syndicator should take you in that type of deal. That's irresponsible. So how do you get up to that? Well, you pick up some turnkey rental. That's how I did it. If you're living in a primary market, California, Hawaii, Florida, well, Orlando and Miami might be a primary market, but there's a lot of other good places in Florida. But New York, Boston, those type of places, you're not going to find the rent to value ratios required to be able to cash flow. And like I said, it's a seller's market. We may be at the top of the market. I think we are. You should be only investing in cash flow today. I've probably taken this from about 3 or 4 people, but this market cycle chart, I mean, this is no secret. The market goes up and down. Typically, it goes down a lot quicker than it comes up, right? So like, if you think 2008 to 2011, the market was falling in that period. But from 2011 all the way to now, I mean, it's a much slower recovery. Normally, you're looking at a full market cycle from top to top or bottom from bottom, however way you measure it, of 8 to 12 years. Do the math, 2008 to 2019 is 11 years. So one of these, with that in mind, I try and stick to class B and C properties. Those are the 4 property classes there. Typically A class are going to be your more luxury properties. You're not going to have the rent to value ratios necessary to cash flow. Class D properties here on the left side are going to be too much of a headache. And class B and C are sort of the sweet spot. It might be a culture shock for a lot of us, but the population curve is mostly centered around class D houses and class C apartments. I think a lot of people, they hear about investing in places like Nevada or Las Vegas or Florida or Phoenix, Arizona. I think that those type of markets might be a little bit of sucker plays, if you ask me. And the reason why I say that is a lot of unsophisticated investors in California will want to be a wannabe investor. And yeah, they've been to Las Vegas before. Who hasn't? And they feel comfortable because one time their Uber driver took them off the strip, off Tropicana, and they saw some rental properties out there. So there's a comfort feeling there. So look in the last big trough we had from 2016. The market dipped from 2006 to 2011. Look where all the red is. It's all in those speculation areas. So again, that's why I kind of stick more towards that southeast area where the job growth is and the population are. Because the theme of today's talk is, what happens in a recession, right? How do we recession-proof our investments? And it's just kind of speculating what's going to happen in the next recession. So this right here is kind of a simulation of what will happen. Basically the A class residents will move to the Bs, the Bs will move to the Cs will move to the Ds. And you're kind of seeing some cooling off in the upper class, like in Seattle. You used to be able to get a 1-bedroom for $1,700. It's come down a little bit to $1,625. Just to use one example. This is why I kind of like to stay in the class B and C area, because it's those A class deals that, yeah, they're cash flowing right away, and I think that's kind of the lure of them. But in a recession, they struggle the most. Any other questions before we kind of get any of that stuff I mentioned? You guys can type it into the chat box too. I'll put that out too. So typical, when I'm underwriting a deal, probably the third biggest thing I look at are like vacancy rates. So normally class C will have the lower vacancy rates because it's a little bit more demand for that. Class B will be having higher. So here's a little spread. This is by no means what you should be using, but it's good to get a sense of the difference between the three. And probably the second biggest thing I look at when I look at underwriting deals are the rent increases per year. So typically what you're going to do is you're going to use a escalator on your underwriting of like 2%, typically plus or minus 1 or 2% points. In this kind of environment, I would not be using anything higher than 2.5%. So that's a big thing to watch out if you're a passive, or even if you're just underwriting your own deals. So a lot of you guys might be buying turnkey rentals or single family homes. And I'm just going to use this as an example to kind of talk in theory what I'm talking about here. So this is sort of just a scatter chart that I made. It doesn't really have data. It's just sort of theoretical. But, I took like the rent to value percentages that I was seeing for the last few years for a property that rented for $900 a month. And that's probably more like a B minus class property. So you're seeing a lot of, when I was starting to do this, I could find that for a 1.1% rent to value ratio. That has gone down each year as more and more people finally pick up that purple book, Rich Dad, Poor Dad, and listen to podcasts and hear about this cool new thing called a turnkey rental, and they get into it. So what I'm suggesting is build your data point, your scatter chart, and try and build this line of best fit. Because you might have been on a forum 2 years ago and heard that, this is what the numbers on their property is, but that's not you, and nor is it that time and era. You need to be kind of moving forward and just buying the best of classes, what I mentioned before, like, so the dollar cost averaging. So it sounds very obvious, but buy the best in that type, that era. And this is what I kind of do with multifamily. Multifamily is probably about 4 or 5 times harder to underwrite because there's just more variables, where I believe the main variables for single family homes are bedrooms, baths, square footage, date, and rent. Multifamily might have a dozen more than that. That's why I say it's kind of a factor higher of complexity. But at the end of the day, it comes down to what KPIs you're looking at, and the KPIs I look at, unlike turnkey rentals or single family homes, where I'm looking at the rent to value ratio there on the y-axis, I'm looking at the return that I'm seeing if it's underwritten property in 5 years. So when I get a deal package, I'll run the numbers myself with the P&Ls and rent rolls. Then I'll put it on my scatter chart. I don't really have a scatter chart. I just have one in my head because I can kind of remember this stuff. It's not that hard. And I just kind of pick out the one that are best after, best in class, I guess. No secret. And I think that's what you should be doing. Again, the mistake that the beginner is going to make is just, they're going to pick a property, say over here, and they're going to say, well, this is not as good as in 2015 and 2007. And they'll never do anything. And they'll keep working at their job for 40 years, and they'll keep putting money in the stock market, and the stock market will bomb out on them. And we all know how that ends. You guys can kind of read through some of this stuff later, but it's kind of dense. One thing that I've kind of picked up, some people have been kind of telling me about this Treasury yield curve. Something about the 10 and the 2 year is what people like to graph. And this is a little geeky, but apparently a lot of people will say that a recession is marked when the 10 and the 2 year Treasury invert, sort of like what this graph is doing right now. When that happens, you're like looking at a recession 6 to 18 months down the road. So guess what? It happened about a month ago. So it's going to happen. But yeah, like I said, don't be that newbie who doesn't do anything and just uses it as a lame excuse. So here, okay, here's my theory. This is why I keep going into deals. So say I go into a deal that cash flows me 8%. And this is like a CB asset where, it'll fare pretty well in a recession. The guy hoarding cash not doing anything and thinking he's super cool because he's justifying him not doing anything will lose nothing in theory, but they always have something to lose. Nobody can be entirely all cash. But on the other hand, I'm still making money, and the 8% is just my cash flow. That's not including my gain from the forced appreciation. So my theory is here in a recession, my cash flow might dip from 8% to 4%. Now, I don't know if that's going to happen. It might be better than that. I mean, some people will say in a recession, my C-class asset might actually do better. But I'm just going to theorize here and say that it's going to be cut in half to 4%. So that's why I like to go into deals with 8 to 12-year debt terms so that I can bridge over to the next side of the market cycle so I don't have to sell in the down market. But in the meantime, you're making 4% more than the guy hoarding cash making 0. And here's where the argument gets a little bit better. So if you remember, if you think that back to the last recession in 2008, you had about a few years there from 2009 to 2012 where people didn't know if it was at the bottom. Or if you look at that diagram up above the phase 4. So the hoarding cash guy from 2009 to 2012, or if you want to call it projected 2020 to 2023 or whatever, I don't think that they're going to have the balls to do anything. I mean, they're going to be looking at this market and it's going to be like trying to catch a falling knife. I'm trying to I put myself in my perspective where I was in my early 20s in the last recession. And, I kind of saw it all happen. I wasn't really in the game, but I saw it happening. And I don't think I would have been able to say, yep, this is the bottom. We're going to go after it. I mean, I bought a house at the right time in 2009, but it went down for a few more years after that. Didn't really start picking up to 2012. And we don't know how the lending environment is going to be, because I think a lot in 2009 to 2012, a lot of the lending dried up. So even if you had the sports almanac from Back to the Future and you're able to project when we were coming up, I don't know if you would have been able to close deals using leverage. So let's just assume that it's 4 years of the doldrums where the hoarding cash guy is not doing anything. And me, the person who, my cash flow got cut in half to 4% a year. But for 4 years, I'm still cash flowing, repositioning the property at probably even less cost to, because contractors are just desperate for work at that point. So I go 4% times 4 years, I'm still 16% ahead of the guy hoarding cash. So that's kind of my grandmaster. I guess that's my hypothesis, what's going to happen. And that's kind of why I keep moving forward. But the deals have to be underwritten to be able to withstand that first shock of the market. We'll finish up here with this talk on equity, that this plagues probably most investors. So most investors, you'll probably make about 30% a year on your money initially. If you leverage it effectively, you can watch the video at simplepassivecashflow.com/returns. So this percentage includes cash flow, mortgage pay down, appreciation, even though I don't really count appreciation, but there's a little bit of appreciation there and the tax benefits too. So in the beginning, you're making like 30%. And as time moves on, from 2010 to 2015, the property value goes up and your tenant pays down your mortgage. So you're getting more equity. So which is a good thing. But unfortunately, you're pretty much making the same thing. So your return on equity gets lower and lower and lower. You can see how this trend line goes. It kind of goes down below 10% there 10, 15 years later. Personally, when I get to about anywhere from 10 to 20%, I feel like it's time to re-leverage. And how that looks on the graph is you sell it. Here, 2017, you sell it. You either do a 1031 exchange, a sale, or a cash out refi and re-leverage it, and you get that return on equity back up. Because it's all the area under curve is what investors, really sophisticated investors, look at. The scenario with the investor, and these are most investors out there actually, they hold on to properties forever and they never get their equity moving, and they just follow this curve all the way down here, down to single digits, when for amount as effort as it takes them, they should have been in a savings bond. And they're probably still working at their job because their money wasn't working hard for them. What they probably should have done 10, 15 years ago was re-leverage it and go into another asset. Now that's a little bit more hard work, but so is working for 10, 20, 30 years too. So that's kind of that high level on that. Did any questions before we kind of move on? This is kind of the end of the whole talk.
No.
All right. Well, so what I wanted to do for the last 30 minutes, and this is what we're going to be doing in the Journey to Simple Passive Cash Flow mastermind here. I see a couple of you guys who are in it. So I'm just kind of testing this for the group when we go live in a couple of weeks. The whole point of the group are, people are sort of paying to get into the group, and it's a more high quality group of people. And I always found that it was really cool when I could talk to a few investors that were also investing in, say, Birmingham, that we knew who all the vendors to use, and I could be able to text somebody if I needed a vendor for HVACs, or my property manager wasn't working for me, so we need to go to somebody else. So that's what this program is. You guys can check it out, simplepassivecashflow.com/journey. But we're going to test this cool thing out called breakouts. So what I'm going to do is I'm going to split you up in pairs, and you guys can kind of connect with the other person. I'm not going to hear anything. I'll put the timer on the clock for about 10 minutes, and then I'll use the magic of the internet to connect you with another person. Yeah, I think at the end, I'll have you guys put your contact information in the group chat, and I'll email it out to those who email me and request it. If not, tell the person that if you guys want to exchange information, if you would like. So I'm going to test this out. Sorry, this is new to me. So Duke, I'm going to put you with somebody on the phone. I don't know who that is, but
okay.
Hopefully they're there. All right. I got everybody assigned here, and I'm going to send you guys off to go hopefully meet a good buddy for the rest of your life. Bye. Yeah, it does look like it worked out pretty well. Yeah, so that's what we'll try in the mastermind stuff, and I might do it in the future.
One quick question, Lane, if you don't mind.
Yeah.
It's bugging me. I gotta ask you what that flashing light behind you is.
Oh, you can get it on Amazon. Type in
What is it?
LED light bulb.
Okay.
Yeah, it's like $10.
And it's just to freak us out or something? Is that the purpose of
it looks like a flame, and like it's even gravity sensitive. So if you turn it on its side, it kind of tilts upwards.
Oh, okay.
Yeah.
It's just so stupid people like me would ask about it, right?
Yeah, just in case you go to sleep, it kind of keeps you awake there. Yeah.
It's kind of zoning me out right now, you know.
Yeah, it's all part of the production.
Oh, okay. I see. I got you. I got you.
All right. All right. Talk to you guys later. Bye.
Thanks, Lane. Aloha.
Well, thank you for joining, guys. Really appreciate it. If you want, shoot me an email at lane@simplepassivecashflow.com, and we'll see you guys next time. Bye.